Welcome to another weekly market insight. Chris and I try to sift through the noise to get to the signal to give you actionable advice so you can make informed decisions. I'm actually in Dallas here for a seminar at the Westin in Irving. Chris is still back at the in the green room with our new sign. It looks great. Chris, you look good too. We are
Thank
actually
you.
doing pre-record on Tuesday after market close because I will be in a seminar all day tomorrow. So Chris, how are you doing? St. Louis still functioning, working?
Yeah, things are doing okay without you. Market's down a little bit though.
My wife said that there's a thunderstorm and possibly tornado warning coming.
Yeah, my roof's leaking, so I got to deal with that. But anyway,
Well, why don't we just jump right into it? Let's hit price points for dollar cost averaging. So where are we at on the market? What are you seeing going on?
we've had a few percent pullback. We are now down about to the 43 range. Seeing next support is a little bit lower at 41.70, and that 45 mark is going to end up being resistance on the way back up. But last week, not really a whole lot of news. The Fed minutes were released, and we'll be going through them later on. But it's hard to say if that's what caused the pullback. Market was already pulling back before seeing the notes were a little bit bearish. They were certainly hawkish.
Hawkish relative, chicken hawkish is what I'd like to call them. We did get some news out today, though. We had CPI,
Mhm.
where it was fairly hot if you're looking at the all urban consumer CPI, U.S. city average, all that Fed speak for the specific index.
Yeah, we did.
1.2% for March. What are your thoughts there?
Yesterday on Monday was actually a really rough day in the market, and we didn't close strong today either. But large cap was down about 1.5 to over 2% if you're on the growth side yesterday, and really the market was bracing for a really bad CPI number. It's pretty typical with news, and that's what we got. We got 1.2 on the headline, which is a monthly number. So annualizing that out, if that number were to hold going forward, that'd be over 14% annual inflation. I don't think either of us think that's going to last too long, but gasoline prices were 50% of that gain. And
Right.
the Fed knows that raising rates, what can they do to really cause gas prices to go down with their rate hikes? I don't know, maybe you think they could do something small, but the Keynesian view, of course, is that they're not going to have any effect on that.
Right. They could raise interest rates up so much that people start saving a lot, so then it would drive prices down. But that would take quite a lot of pretty high interest rates to get people to do that. But then if we look at what the Fed would say is, let's look at it X the energy, food, things that are more volatile. Let's just go to core. That number didn't look too bad, right?
Not at all. It was up zero point 0.3 on the month, so annualizing at 3.5 or so. That's not bad. They could hide behind that and say things are okay. And we haven't seen zero point 0.3 on core for several months. In September, we were in that zero point 0.5 to zero point 0.6 per month. So that is the good news from the CPI, is that core inflation is growing slowly, and the market did initially rally off those numbers pretty significantly, returning back some of those losses from Monday, and then into the close we did fade a little bit, but.
Well, even at point 0.3, though, it would still be above the Fed target of 2%. I
Mhm.
know they've said that's a moving target and they'll average. Another thing that we've talked about is we said that you wouldn't see headline CPI numbers really come down until Q3 or later. A lot of that is because of just how high they were built up. If you go back to September, zero point 0.4, October, zero point 0.9, November, zero point 0.7, you can go all the way out. The 1.2 is actually the highest that I'm looking at here. Well, it's going to take time for those to drop off, and you got to see that. So we've been expecting high headline CPIs when you look back 12 months to remain elevated for quite some time. I do think with I don't know how much you're catching it, but Shanghai, China, a lot of lockdown there. They're still using a zero COVID policy, and that's kind of given some relief to gas prices. I can tell you it wasn't $100 a fill up while I was driving down to Dallas. It was about $73 for a fill up. And one of the things that we've talked about is that relationship between the headline CPI, the core CPI, is if gas is taking a lot of money out of your wallet, you have less to spend on the rest. So it's not uncommon to see those two numbers be divergent whenever you have such an extreme move like this, where gas is taking up so much of that wallet share.
Yeah, I think that's a good point.
What about
Well,
Fed meetings?
yeah, so,
What are
so
they
the
doing?
Fed meeting, we can look at the minutes, and we, of course, read those. And I really have two takeaways from the minutes. And the first is they're looking closely at the yield curve where the yields are currently and where people are expecting Fed fund expectations to be. And second would be balance sheet runoff is essentially ready to go. They're ready to kick that off at the next meeting. So starting with rates, many of the members stated that they wanted a 50 basis point increase in March. Of course, they only did 25, but they cited Ukraine as a reason, of course, hiding behind it. Russia, I should say Russia. They cited the Russia as being making it too unclear, and they wanted to hide behind that. And they said, all right, 25 basis points. We need to start. We need to have some credibility, but we can't do 50 yet. So that was really the first thing. And then the second thing is, if we look at what is the market projecting here now for their next meeting in May, we're at 85% probability of the target range being 75 to 100. That's a 50 basis point increase coming the next meeting. They said they're looking at this. So the market's really blessed it and said, hey, we're expecting you to raise 50 basis points. They're saying they want to raise 50. It's probably going to happen.
So, do we need the Fed if they're just looking for the market on what the raise rates at?
That we could do a whole call on that one, especially when it comes to the balance sheet.
Well, let's talk about the balance sheet.
Well, sorry, one more slide before that. And they also said they're looking out the end of the year expectations, which at the time were much lower. They were talking about the midpoint being about 1.7. So that it's 6 or so rate hikes. And today where it stands is the market's actually expecting 9 total for the year to get to that midpoint on the FOMC rate, that 2.5%. Pretty high, but market's expecting it again. I think we're probably going to see them at least start to head towards that.
Well, do you think we're going to get 2.5% in our savings accounts?
No, I don't think so.
But the other thing that they talk about is the balance sheet. What can you interpret what they're saying?
Yeah, so let's just start with what the balance sheet is. Right? They call it quantitative easing. They're just creating money to buy assets, and they bought treasuries and mortgage-backed securities. So like you said, what do we need the Fed for? Should let the free market play out. But they didn't let the free market play out, right? And in 2020 with the lockdowns, no one would be writing mortgages. They didn't want to see a mortgage collapse. So they told banks, we're going to buy mortgage-backed securities. Keep writing them. We'll be the buyer in that market. And no shocker, by now you've accumulated all these treasuries and mortgage-backed securities, and now we're seeing the inflation from it. So now they're saying, well, what do we have to do to get out of it? And you can really see here in this chart, they tried to reduce mortgage-backed securities and treasuries back in 2017 and 2019. You can see that decrease coming slightly, and then the explosion up in 2020, where they were buying 120 billion a month, split between the two. Get you to where we are today, where they have not rolled off anything. But the plan, which is what they talked about, is to roll off 60 billion a month in treasuries and 35 billion in mortgage-backed securities. Of course, they set a cap on it. So they said they're talking about a cap, at least this isn't set yet. But that 35 in mortgage-backed securities, they said, it's probably going to be hard to hit. You don't have a lot of principal payments coming in on those mortgages with rates coming up. There's not a lot of prepayment going on. So they said eventually they're going to have to start selling those, but they're not going to start straight selling them for a long time, at least into balance sheet runoff. They want to at least get the market prepared, start rolling off these treasuries by not reinvesting them when they mature. And the same with the principal payments that are coming in the mortgage-backed securities. But What do you think projection wise? I know in this chart here,
Projection wise,
J.P.
well,
Morgan.
yeah, we may reduce it. It'll probably be something similar to 2019 to 2020, where all of a sudden they have to come back in. Because what's happening, we can get through the technical things, but Fed creates money and they buy bonds. So then the money gets put in the economy, and then these bonds come on their balance sheet. When they're trying to sell it, those bonds come off. They're they're mature. They just disappear, right? They're gone, and then that money comes back into the Fed and it comes out of the economy. Well, that contracts the money supply, and typically, whenever that happens, you'll have a liquidity crisis because there's cash that's actually getting destroyed instead of created, like the quantitative tightening. Then you'll start to have that recession. You know, if we look at the money supply numbers, we're already seeing a significant slowdown in the growth of money. So I'm not saying that money is disappearing out of the system yet. It's not being extinguished as debt rolls off the balance sheet because they haven't started that yet. But just as much as rates are responding to the Fed, banks loaning money out are also responding to the Fed, which is another way that money is created in the system. So if we're looking at this, and I won't get into the details, the point of that green line is it's the growth rate of money is really dropping off rather quickly, and that's concerning to us. We're starting to see some value names defensive, trying to remove some cyclical names out of our portfolio. It's still very early on, but we would not be surprised to see a recession. Now, the thing is it could be a head fake. We could see money supply all of a sudden take off. If higher interest rates are on the longer end of the curve, banks may want to loan money out. So it's still too early to say, hey, let's abandon markets. But we're already starting to see this play out with some of our warning signs to become
Yeah.
more defensive and rotate to less cyclical names.
I know there's some seasonality in that chart, but that yellow line was the rate of change last year, and there was a steep decline similar to what we're seeing now, and it did bounce back, but it bounced back. The Fed wasn't rolling off bonds and reducing the money supply, so it's going to be a little bit more difficult this time.
And there is seasonality to it. To your point,
Mhm.
September, October. I don't think it's a coincidence that that's the low season of money supply creation for whatever reason. No one can't figure that one out why it does it, but it always coincides with a significant market sell off. It's almost always September, October that we have a really bad bear market. Whenever it's something like a 2008 or a Great Depression, it's in that September October timeframe, and I don't think that's coincidental. And we're seeing that drop off earlier now, but I still would expect a September. But it's gotta, if it gets too much lower too quick, then we'll start to see actually money contract, and we're not going to wait for September October to become defensive if we see something like that. But it's definitely different for this season. And
It's a
then we
good
get to the
point.
yield
And
curve. Seen some improvement there though. So enough negative.
yeah,
Let's talk about
yeah,
positive.
getting something at least somewhat positive. The red line was the inverted yield curve. You see those longer maturities are below that 2 year, and blue is the last close, so yesterday, and we even had more steepening today. So we have over 35 basis points of spread between that 10 year and that 2 year. So at least the yield curve is improving.
Right, and then a point about the banks being able to also expand the money supply, it really is a big factor on this yield curve, that spread that they can borrow from and lend from. So to see positive, that could be what helps as a catalyst actually get money supply starting to move again. So we'll continue to watch that. It wasn't negative long at all, but it's still not extremely positive. Uh,
Yeah.
One thing that we talked about CPI earlier. An area that actually saw a pullback in price was used cars. Why don't you tell us a little bit about CarMax and their report?
Yeah, so I haven't had a time to go fully through the report, but I did see the headline, and they're worried about demand destruction, stuff we've been talking about, and at least from their same store sales over the last quarter from existing stores, they saw a 6.5% reduction in units moved for cars sold. So they are getting worried about that. And when we start to frame out earnings, looking back into this first quarter, by the end of this week, we're out of the 500 companies, we're only going to be at 34. So while we're speaking today, it's somewhere in the low 20s. So getting a full sample is hard to do, and it's going to be changing every day. They have been beating estimates. Estimates are, as always, and we're going to show some estimates are usually low, and so they've been beating by a couple percent. While the market really does like to see beats in the 4 to 5%, at least historically. So surprises have been positive, but not as positive as you'd probably want to see.
Tell me about earnings revision. What's going on
Yeah,
there?
so I just want to show the revisions. This is just a movement down of only about 2%. So heading into Q1, expectations were not great. So only had to reduce by 2% to get to where we are today. So if we look at Q1, and this could change depending on whose numbers you're looking at, but in this example, we see in the bottom here 6.1% Q1 2022 earnings growth. So sounds pretty good. But if we remove energy from this, since we see energy's expectation for growth is 240%, we get below 1% for the rest of the market. So analysts are not expecting a strong quarter. We see declines here and projected in consumer discretionary, pretty sharp decline in financials, and then small decline in communication services. So analysts are saying don't expect much here. Again, they are usually off by about 4 or 5% to the low side. The market does come up higher, but if we look out to next quarter Q2, actually projecting out, we see something similar. So about 6.9% growth, and removing energy again, only about 2% growth. The rest of the market. So kind of similar to what we said about the Fed is the market shouldn't be expecting big numbers here, and I'm not expecting big numbers. I think they're going to come in here. I know we also look at Ed Yardeni's expectations. He does kind of bake in that extra percentage that they've been missing on the low side. And really, what I'm looking at is on the bottom pane of this chart is really long term. So 2022, a 9% growth for the whole year, and 2023 getting back to that 10%, which is what we want to see, 10, 11% at the end of Q3, Q4. I want to see what's going to keep us from getting there. Because if something's going to keep us from getting there, we're going to see a significant decline in the market multiple, all that's going to be start to come down, because market's still trading at over 19 times next 12-month earnings. So they are expecting to get back on track and get towards these numbers.
Right, and I would say that if we do get into recession, these are probably good numbers if we are in, if we go through the recession. But I would say they're definitely not looking at it as if it's this perpetual bull market forever. They're going to have big. These are pretty reasonable, probably on the low end projections. If we have a recession, obviously there's going to be some negative earnings, and then they'll probably come out with projections that are way off, just as much as they're off in a strong bull market where they just think everything's going to work out quite well and we're going to have 30% earnings growth for the next 15 years. It'll be just as pessimistic as it is optimistic. So these are probably very realistic returns and something we can work with. And I would say even if we had a recession, Yardeni with his, I think we had looked at it was 15% return for 2022. That could still be a number that was hit. We could have a dip or recession, especially if it starts early enough in the year, and then have the Fed step out, say, no, we were kidding about having interest rates decline and rolling off our balance sheet, and then all of a sudden it kicks back off and we end up 15%. All of this can be true in 1 year because there's just still so much time left.
That's a
Speaking
good
of
point.
time left, we probably are running out here. And we really appreciate you tuning in on the weekly market insight. If you have any questions, any concerns, uh, especially on the talk on recession, the big R word. I know we probably aren't supposed to say it as people in the financial world, but we do see the probability increasing. But we're also preparing. Please reach out to us. Call your lead advisor. Call the number here. Call Chris or I if you want to discuss. And we'll have that number up here. We really appreciate you tuning in. Go ahead and hit that subscribe button if you're not already subscribed. Hit that share button if you think other people should understand and know that a recession is possible and likely to come within the year, where we start to see some of that data show up. Share this video with them, and we really appreciate you tuning in. We'll catch you next week on the next Weekly Market Insight. Thank you.